Good afternoon, everyone, and thanks for joining. My name is Janet Wright with Farm Service Agency's outreach team, and I have with me today Adam Kantrovich from Clemson University and Ruby Ward from Utah State University, and they will be discussing demystifying tax records. And during the course of this presentation, you will be able to put your questions into the Q&A box, and at the end of the presentation, they will answer as many of those as possible. This presentation is being recorded and it will be posted to farmers.gov/taxes in about 2 weeks, and you will receive an email when that is available. And so with that, I will turn it over to Ruby.
Thank you, and welcome to our webinar today. I'm Ruby Ward from Utah State University, and I'm also joined by Adam Kantrovich from Clemson University. And we're going to talk today about demystifying tax records. This is a topic that we routinely kind of get questions. People are saying just kind of what do I need? When do I need to keep them? They just kind of feel like there's this big mystery there. And so this webinar is meant to just kind of go through that and demystify it so you have kind of at least an overview of what you're going to say or what kind of records you need to keep. We are part of the National Farm Income Tax Committee, and we have a website hosted here at Utah State University on ruraltax.org that has a lot of information. At the very end of this webinar, we'll go through some of the specific information that's on that website that you can dive into more details on things that we're covering today. This is part of a project that we have with the U.S. Department of Agriculture, and you see the agreement number. And so, as always, the views expressed here are on the authors and not necessarily the Department of Agriculture, and you can see the rest of the disclaimers. So, when we're talking about taxes, I think it's important to kind of just understand that what you discuss in an educational type setting is always going to be a general presentation of just kind of an overview of how certain tax concepts work, how they work within the context of farming and agriculture. And then, as with every tax or legal situation, the exact answer really depends on a lot of nuances and the facts and circumstances in an individual situation. And so, this is a broad overview. Treat it as a broad overview. It gets you a general feel for what's going on, but it's you'll want to approach and work with your own tax professional to really kind of look at your unique situation and circumstances. And then, as always, if new laws get passed, then the information in here, those tax laws may change. So today we're going to first go over farm records and give you an overview of kind of what those are and how long you need to keep them and things like that. And then we're going to go over working with a tax professional. So now that you have your records, how do you work with that tax professional to have the appropriate tax records so you can do your tax returns? And then records with non-farm activities. And so if you have additional things that you're doing, how to separate your records and issues to think about there. And then I think really important is the good practices, because this is really kind of after you've seen the broad overview and we've touched on all these concepts, really what are some things that you really need to kind of think about and those take-home messages. And then we're going to go over those resources. And so a lot of the information in the webinar today, we have some additional topics that you can dive into for a little bit more details on those. So first of all, records and working with a tax professional. So when you think about records, there's a lot of different types of records you can keep for various portions of this. And I believe my co-presenter, Adam, is here, and he's going to talk a little bit more. Maybe not. Okay, so I'll just keep going until he comes. So you have records for various types of purposes, and banks, your lenders have records that you'll keep for them depending on your loans. Farm Service Agency, some of the programs there's been various ones that need different types of records. Sometimes they overlap with the same records you use for your tax information, but sometimes it's different records. Internal Revenue Service for your tax records, state departments of revenue for state tax issues, and then insurance, crop, property, different records you need there. EPA, US, the Department of Labor, FDA, state agencies, departments, regulatory agencies. So there's a whole broad group of things where you need to keep records. And we're not going to go over all of those today. We are going to primarily go over the record keeping related to tax, how to, so that you can manage your taxes and you can correctly file your taxes. And so I think Adam's joined us. So do you want to take it away, Adam?
I apologize. I got stuck in the other room. It would not let me out. So for record keeping, the basics on here, these are just a couple of little hints that you need to understand because this plays a significant role. Although we are talking about records that need to be dealt with from a tax perspective, it does start off from our accounting financial information. So it's important to be able to keep track of a slew of different activities throughout the year. And this includes our financial records, which are directly applied with regards to our accounting software, or we may be doing accounting on paper. Our production information, there's a set of records that you may be maintaining with that, and some of that may be used with some of our financials as well. Depending on what type of farm you have, there may be some additional food safety records that may be kept, including organic certification, etc. If you have employees and labor, there are a lot of labor records that we have to understand what they are, the differences, and how they need to be kept. Some of the financial things that we discuss frequently from an accounting perspective, but also that we need to develop summary reports for to be able to provide to our tax people come directly from our accounting. And this includes our revenue streams, this includes our expenses, and those are different than capital sales and purchases. And those have to be kept separately as well. If we are farming, and we have these farm activities. And I know many of us, when we first start off farming, we don't necessarily treat it like a business. It's a little bit of an offshoot that we've started. And we may not have a separate checking account. We may not have a separate checkbook and all these other things. But it's very important that we ought to have a separate bank account, one for the farm and one personal. And then we have to keep up with, obviously, both of those activities. And this includes when we reconcile our information. This should be done timely, at the very least, monthly. So we need to be able to keep up with all of these, and we ought to be meeting with our tax professional, the person that's going to be preparing our taxes for us. We ought to be meeting with them throughout the year, not just, here's all my stuff, and please file my taxes. There ought to be some more engagement with your tax professional before the end of the year so we can deal with some tax management strategies, as well as making sure that our accounting is being kept up, is up to date, and being done appropriately.
So here are how long you should keep records according to kind of the overall tax period of limitations. So generally, the general idea is 3 to 7 years. Indefinitely, though, if no return is filed or there's a fraudulent return, then the IRS can actually, if they need to look at something, can go back further than that. For property or fixed assets, 3 years from disposal. And so from the moment, so the records from when you purchase it all through when you hold it, and then 3 years after you dispose of it. Major items, it's really to keep them indefinitely. Tax-related employment records, 4 years from when the tax is due or after the tax is paid, whichever is later. And then this is not, the Form I-9 is not a tax record keeping requirement, but it's related to stuff. And so Adam's going to go over that, I think, a little bit.
So the I-9 form, and this is one of those things unless you have already been an employer and have gone through processes of having laborers, workers directly working for us, this could be a very new world for some of us engaging with regards to payroll and dealing with labor. But the I-9 form is something that must be done, including if I hire a relative, you still need to do an I-9 form. The I-9 form is known as the Employment Eligibility Determination. And this is something that there are portions that the employer fills out, and there are portions that the employee must fill out. This must be retained for 3 years after the date of hire or 1 year following the termination, whichever is later. And so, one of the issues that we have with regards to this in many cases is one, it's not been done. And the agency that has the responsibility and is allowed to come onto your premises and do an audit for these is actually immigration, not Internal Revenue Service, not Department of Labor, but immigration. And so they do this. One of the things that we usually catch is that you need to make sure that you are using the correct form. These forms get updated on a regular basis. And if you look in the top right corner of these forms, you will see an expiration date. And that's usually the date you go by, the one that's furthest out. And so the newest form presently is May 31st, 2027 expiration. And so we want to make sure that that is the date on the form you are presently using this year for all your new hires.
So those were the what the IRS and kind of the legal requirements for how long you need to keep records. But some good practices and just kind of an overview is if in doubt, keep it. It's better to keep records than to not. And then financial records, keep them for a 7-year minimum. All records related to employees. The limitation was 4 years, but really we recommend keeping those for a good 10 years. And then general ledger, financial statements, information, keep that indefinitely. Ownership and formation documents for your business indefinitely. Business meetings indefinitely. For some of those organizational structures, you need those business meeting minutes and agendas to kind of go back and show that you were actually operating the way that you were supposed to be operating. And I think Adam has a comment here.
I do. So we talk about how long should I keep these records for, and everybody hears certain things from our tax preparer from a legal perspective, and it can become very confusing and very cumbersome. And so I would hope that everybody heeds what Ruby's just said. But I do want to make a special note. All records related to employees a minimum of 10 years, and there are some very good reasons with regards to this. There are certain things that may occur that somebody may come back many years later and accuse you as an employer of something. And so we have the statute of limitations that occur. And some of this is dealt with at the federal level. There are other pieces that are dealt with state by state. And so you will hear from many individuals, especially as it relates to employees, in case somebody comes back and tries to claim something. If you had already gotten rid of all of your records and destroyed those records, you may not have the ability to provide the evidence necessary to show your innocence. And so this includes things like human trafficking. And many times we think of human trafficking as like a slave trade, but there are other things that may have occurred that we don't think of, that the Department of Labor may say this falls under a human trafficking related issue. And so holding some of those things for 10 years electronically or in hard copy is just something to cover your bases in case somebody does come back many years later.
And so then kind of just going on, your deeds indefinitely, or, at least copies of what they were after you pass those deeds on to somebody else. Once a year, you should have a cleansing day. filing long-term electronic files. I know my electronic files, sometimes they get a little messy. And so when you go back later on, you can't remember like what version you had and where you saved it and stuff. So it's just a good practice at least once a year to just go through, make sure you have the final corrected versions of things that happened during that year and get those parked into someplace electronically. And then it's also a good idea to have a copy of those that's in kind of a long-term storage away from your premises. And then the same thing with your filing cabinet. So a lot of times your current transactions will be like in a file cabinet or somewhere that's really accessible. And so once a year, just kind of take those current year, make sure you've got everything together. And then a lot of times people will just buy those totes that the manila, those the plastic tubs with the lids that the manila files can just kind of sit in there. And so they'll just take everything out related to that year, put it in those tubs, mark it what year it is. Depending on how many transactions you may have more than one tub for a year, but you may also have multiple years within the same tub. And so just have something to separate those and know what years and where they are. And so that's just a good practice. And then moving on. So we spoke about what we need to, how long we need to keep records and, from a legal requirement, and then also just some good practices. Here now we're getting into what records to keep. And there's a concept called constructive receipt that just says this is the information and the questions that you need to answer from your record keeping system about your transactions. So when did it occur? Where was it? And what was purchased or sold? That's kind of your overview, general questions. So for an example, on January 18th of this year, $1,200 was a charge from co-op. And so when we look at that information there, that's not enough information in your record keeping system because we know when it occurred. It occurred on January 18th. We know, well, we kind of know where it was because we know it was from the co-op, but is there multiple co-ops in your area? I know in my area there's multiple different co-ops. And so we really need to know kind of where it was purchased. And then what was purchased, we really don't know. We know it was $1,200 worth of something, but we really don't know what that $1,200 was. And so if we look and just add some more information to that, our record keeping system really needs to have this information in it. So it was a 1,200, so it was from Farm Services Cooperative. And that $1,200 was a combination of things. There was $450 for fencing, $400 for irrigation supplies, and $350 for seeds and plants. And so that transaction in your record keeping system would actually need to be split out into those three different categories or those three different lines so that you know what portion is for all of those various categories.
So on the constructive receipts, we can keep these constructive receipts. We can keep them in digital and or physical copies with regards to these. We need to make sure that we are able to identify quantities in the items. So in many cases, there might be opportunities that we take advantage of, let's say certain tax management strategies such as prepays. And so when we do prepays, there may be some additional information that becomes very important, as Ruby just discussed, that we want to track. If you're also working on utilizing a system for enterprise management to be able to make better management decisions, we really want to be able to make sure that these receipts are able to identify the quantities of what we are purchasing. And if we're using QuickBooks, we have many individuals, and QuickBooks allows for images to be attached to a specific transaction. So you can scan in your image, you can take a picture of it, transfer that to your computer, and then attach that to the transaction so that if we need to later on, we can actually take a look at that actual receipt. So that is something to consider. Another thing that we need to make sure of, we started talking about capital assets, and those capital assets, again, may include everything from land to machinery and equipment to computers to other improvements. Now, all of this being said, those capital assets, sometimes we may sell them. We talk about tax basis, etc. So we actually need to hold on to these receipts and any and all documentations around that particular capital asset from when we acquired it to at least 3 years after divesting or selling, trading in, gifting, etc., that particular asset. So those two pieces, we may have depreciation recapture that has to be figured out. There may be capital gains that has to be dealt with and paid. So all of these are determined based off of the information about from when we acquired it, any adjustments that may have occurred while we held on to it, and then how did we divest ourselves from it.
And so when you think about this, like we said, you can keep these receipts digitally or physically. I think there was a comment that came in that said you can also attach pictures electronically to Excel files, and we'll get into that in the next slide a little bit. But it may be that you have certain information in your electronic files or your record keeping system, and then just again, your filing cabinet, your totes, tubs, you may have something with you in your um, pickup or car. So when you get those receipts, when you're on the go, you have some type of just little envelope that you just stuff things in, and then you take that back to your house, you know what I mean, and put it more in your long-term style storage and get it into your record keeping system. So really, it's not about, kind of what works for everybody is not going to be exactly the same thing. And it depends on the situation. It depends on the amount of transactions that you're running and stuff. But mainly just know that there's probably some information from those receipts that might not be in your record keeping system. So you'll have to attach those to it or keep track of those elsewhere somewhere. And then record keeping options, you have everything from manual uh, to Excel or a spreadsheet, that you create yourself. And manual is just, when you write things down physically on a paper, with a pencil or pen. Excel, you can just keep track of that in a spreadsheet. And then you can go on to the accounting software programs. So a really popular general one is QuickBooks. And then there's also some that are related directly to agriculture. A couple of these are PC Mars and Traction Ag. And this is not a complete list. There's more than this out here. We just wanted to kind of give you an overview of this. And sometimes it depends on, I've used spreadsheets when I didn't have a ton of transactions that were going through. But as what I noticed with my spreadsheets is once I started getting quite a few transactions, it was just too cumbersome to use the spreadsheet. And then I wanted to switch into something that was set up for that more as an actual accounting program. If you're doing very few transactions, I've seen people actually still use some manual sheets and papers and have their receipts, you know what I mean, the little envelopes that they attach to those manual things and take them in. So I think the shoeboxes still exist, but really is what you find though is it just becomes almost more timely and costly in terms of your time for some of these as you start to get more and more transactions and more things are happening. And so really the correct version, like we always say, is really just depends on your unique situation.
Yeah, I think it's important to, there are still even some extension services that you might be able to receive the old extension record keeping book, farmers record keeping book. If you use that, typically I don't recommend still using paper for the reasons that Ruby had said, but many of these software packages allow you to download a little piece, a small little section to review it and try it out. You need to find the one that works for you. And I'm also going to tell you that in many cases, you may ask your tax professional that's filing taxes for you. They're going to tell you what works easiest and they're most familiar with in many cases to make things relatively easy as a go-between. You really need to decipher and figure out what kind of information I want to keep. What do I want to do? Find the one that works for you and go with it. Facts and circumstances are going to determine what is appropriate.
And as we said, kind of at the very beginning when we talked about records, there's records for multiple purposes. And we were mostly just kind of talking today about for tax purposes, but it's really a lot of the financial information and stuff you're going to use for like managing your operation and other stuff. And so just kind of keep all of that in mind because I realize the tax records are not a silo, you know what I mean, separate from all your other records and stuff. So And the other piece of advice I'd have is that sometimes people dove in and wanted to try to keep track of absolutely everything in one record keeping system and set out in January, like some of our New Year's resolutions, that I'm going to keep track of everything. I'm going to split my labor out to every single crop. I'm going to, you know what I mean? And at some point, you just realize that life takes hold and you can't do everything the way that you want it. And so, what we're really providing here again is the overview of the information you do need to keep track of, giving you some options and stuff. And then any additional information, maybe don't try to tackle everything at once if you're trying to add additional information in there, but kind of pick your battles as you go through. And something that's really sustainable for you is going to be better than anything that was tried to be more elaborate, but you can't keep up with it. And so now that we have, kind of how to keep those records, what information you need in here, the final step of this is really kind of what do I take to a tax professional? So how, and Adam's already kind of alluded to this, is how do I take this information and then work with my tax professional to actually use it to create my tax returns and stuff. And so this is a very general list of information that you might need. And so summation of the current year transactions based on tax line form. So on Schedule F is where a lot of your farm stuff will be, but not all of it. And so things like seeds and plants will separate it out from rent, fertilizer, just et cetera. But, kind of categorize all those expenses. And then your capital assets and purchases, as Adam also has alluded to a little bit earlier in the presentation. This is your equipment, your machinery, land, and buildings. You need to have information on any sales or purchases that occurred during the year because that'll affect the depreciation on your tax returns, and it also affects multiple other things in there. So any sales or purchases that you had, let your tax preparer know about those. And then 1099s, it's an informational form that the IRS has. There's various types of them. You might receive some 1099s and you might also be obligated to send some out. You may send those out directly yourself. And so if so, you want to have copies of those or that information that you give to your tax preparer. Or if your tax preparer is going to be sending out those 1099s, the information that they'll need, and you'll probably have to work back and forth a little bit, at least initially, to know what information they're going to need for those 1099s.
And I will say on the 1099, sometimes those can get overwhelming. Depending on the accounting software that you're using, some of those have some very special functionalities to them so that when I am receiving income or I am paying somebody, when you develop vendors within the accounting system, there may be some additional functions that you can kind of check mark to be able to help run some summary reports, to be able to help provide you with those reports, whether you're going to develop those 1099s yourself that you have to send out, or at least develop those reports that you can hand to your tax professional. That helps specifically tell them so they don't have to go searching through all of your accounting to figure out who you have to give those 1099s for and for what.
And we actually have a webinar on 1099s. The recording is there that you can get to that. And then we also have short articles, we call them tax topics, and the ruraltax.org website. And so at the end, we'll bring back up some of those that are related today, and the 1099s is one of those. And so another piece of information you'll want to do is your end of year statement, such as things that you get from your financial institutions on your debts or your loans, anything else that you might have there. Because your loans and your debt, you're going to have to separate that interest from the principal on those loan payments and keep track of what you have there. And then also any other income producing accounts that you might have, any forms, documents, or documents for employee transactions and changes, and then end of year information on your insurance. Again, this was a really broad general list to kind of give you that kind of where you're shooting for, but the individual circumstances may require some other information that you'll have to go back and forth with your tax preparer. Or it may be that some of these things on this list, because of your situation, you may not have any other income producing accounts, so you wouldn't have any information that you would provide to your tax professional for that. So this can get you started with this list, and then as you go through and actually are working and with somebody to file your taxes and other stuff, you can go back and forth on additional information that you'll need to be able to provide to them. So this gets into records if you have non-farm activities. Do you want to take it away, Adam?
I sure do. And again, I apologize. Apparently, my campus is having problems, or maybe it's my computer with it slowing down. So if I freeze again, I am going to just shut off my video to see if that helps. But we have many individuals. Again, I don't know. Every individual has its own facts and circumstances with regards to their farm, what they're doing. But it is not uncommon for individuals to really have two different activities truly taking place. And so we have a lot of things that we may be adding value to an agricultural crop, and sometimes this creates some unintended complications. So, what is the definition from an IRS perspective of a farm? One, the farm itself must have a profit motive. Two, and IRC is an abbreviation for Internal Revenue Code. A farm includes livestock, dairy, poultry, fish, fur, fruit, and truck farms. Truck farms are usually those farms that are typically smaller, but they can be larger as well. That usually has a diversity of crops that typically sells direct to consumer through farm markets and farmers markets. It also includes other terms that we use for farms, such as plantations, ranches, ranges, orchards, groves, and the like. So these include our row crop farms, corn, soybeans, cotton, peanuts, our cattle ranches, cow-calves, feedlots, truck farms, orchards, vineyards, and the like. So if we take a look at IRS Publication 225, the Farmer's Tax Guide, and this defines a farmer or a rancher as an individual that is in the business of farming. And that business of farming includes activities such as cultivation, or operation and or manage a farm for profit, either as an owner or as a tenant. And this definition is different than business structure. So these definitions that we've just discussed and talked about holds true for different types of business structures, which includes sole proprietorships, partnerships, or if you have an LLC. Those LLCs include if you're a sole member, which is similar to a sole proprietor, or if you have a multi-member, which is similar to a partnership. And from an IRS perspective, it is treated the same as a sole proprietor or a partnership. Or if you have a corporation, whether that is a subchapter S corporation or a C corporations, or if an estate and or trust is the holder and or owner of the operation itself. So what does sometimes we see, and with the folks we are working with, what may not necessarily be considered a farming activity? Well, custom harvesting is not a farming activity as a farm. They're not going to necessarily file a 1040-F. We may have custom farming that we have hired out or we may be doing on behalf of somebody else. We may have individuals that own horse stables or kennels that we may house animals in, such as dogs when the owner goes on vacation. Those again are not considered farms. Trucking of farm commodities to markets. I may own a trucking business that is trucking and hauling farm commodities to market from the farm. That itself, since I am not necessarily the one producing the crop, is not necessarily going to be considered a farming activity by itself. Landscaping, yard work, mowing, those are not, again, considered farming activities. The next thing that we typically see, and hopefully Ruby's going to jump in and talk about a couple of things here in a moment, but we typically see a lot of merging of farm activities and processing under a single umbrella. And we need to be really careful about this because I may take cheese or I may take milk. I may own the dairy cows. I may actually milk the dairy cows, but I may take some of that milk and I personally process it and turn it into cheese, or I take it somewhere else to be processed into cheese for me then selling that cheese. The act of processing that milk into cheese is it's in itself not a farming activity. When I put down an animal, process that animal, and turn it into meat, this in between and then the sale of meat itself, those are all not necessarily farming activities. And the easiest few that we usually talk about as examples are I have a vineyard, I take the grapes, I harvest those grapes, I turn it into wine, and I sell that wine. The, the act of processing the grapes into wine and selling the wine are not farming activities. And it's the same for raising strawberries and turning them into jams or tomatoes and peppers into salsas.
So, as Adam's talked about, there becomes kind of this sometimes what we see as one operation, like I'm doing the grapes and turning those into wine and selling the wine. So I have a winery or I have, you know what I mean, this operation. And we think of it, or maybe the owner is thinking about as one business, but the reality is because of the way the tax structure is, you've got the farm business that grows the grapes, and then the farm business actually sells the grapes to the wine business, and then the wine business uses those grapes to produce wine and sells the wine. And so your record keeping system has to actually separate those two out. And so when we're talking about the farm tax records, we're talking, that's what we've mostly gone over, but we recognize that in some of these situations, you may actually have some things that is not farming activities. Those will still require record keeping for tax purposes. Another thing that I want to kind of just bring up is this is a but. So a little but, you know what I mean, kind of thing. But there's this term called de minimis within some of the IRS, you know what I mean, and tax code regulations and things. And de minimis means small amount. And so if I'm using my farming equipment, my farm stuff, like I have a truck and a neighbor asks me to haul a load of hay for them, you know what I mean? And they pay me a little bit for that. I'm using my farm assets, that truck that's part of my farm, but just because I hauled that one load of hay for my neighbor, that's a small amount. It's not significant compared to my farming operation. That doesn't suddenly create that I need to keep track of that those truck expenses for that one load of hay separately and what I got from those. Those can, if it's a small amount, it can still be, even though it's technically not what is in the definition of a farm, it can still kind of be considered part of that overall farm activities because it's not significant, small amount. Um, in individual circumstances where you become more than a small amount and it needs to be that separate business and your records need to be separated out versus what they can be together, that's where you really want to look at your situation and work with your tax professional. We know it's a small amount, but it's not really a term that's defined that as a certain percentage or a certain amount. It's just, is it significant or not? And so that's where you'll have to make a determination on your individual operation. Did you have a comment, Adam?
Yeah, I mean, there are many reasons for having these things separated out, like Ruby had said. And we find the de minimis part is very important. Actually, a friend of mine's combine went up in flames this year. And so if I ended up using my neighbor's combine, paid him for the hours used on that combine, that is or I hired my neighbor to come in and use his combine to do it. That's, these might be some de minimis types of things depending on what side of the transaction. But one of the other good things to make sure that, Ruby said, we really have multiple entities on here, using that winery as an example. There are some tax management strategies that can only be used on farm income. And if I don't have this separated, for instance, going back to the winery example, I'm never selling grapes. And if I'm never selling grapes, I don't have farm income. If I'm selling wine, that is not farm income. Therefore, I can't make use of income averaging. And so there's a whole bunch of other reasons why we want to make sure that we have these separate entities.
So, in general, just remember that you might have more than one business. And if you do, it's really a good idea to keep not only separate records, but have separate bank accounts for those. And then you need to document kind of how you're having one business purchase, you know what I mean, that product from the other business. It should be fair market value, but just have something that kind of sets that out. And so that was an overview of records working with your tax professional, you know, kind of how we do it. Now, here we're going to get into just some overall good practices and what does this kind of look like throughout the year. So, in early spring, before you start getting really busy with farming, is a good time to find a tax preparer, or if you already have one, then you know you already have one that you have multiple years relationship with. The only problem I would say with this is that tax preparers are also very, very busy early spring. So it might be, you know, difficult to, you know, really kind of have meaningful interaction with them then. But just kind of know that we want to find that tax preparer really early. You know what I mean? You don't want to wait until later. And if you're going to be really busy, you don't want to put that off and then suddenly you're trying to do it, you know what I mean, later on. You really need to have that tax preparer identified early. Meet in November, December for tax management purposes. So they'll need those records up to that point, you know, that are kind of summarized and stuff so you know where you are. There are certain tax management practices that can be done before the end of the year, tax year, and then there's other ones that you do after the end of the tax year. And so this meeting in November and December is a good practice so that you can really kind of go over where your situation is. You can plan ahead for what your tax obligations might be, and then also do engage in any tax management activities that are appropriate for, you know, that before the year, end of the year. And then January rolls around. That's when you want to send out the 1099s and the W-2s. And you're responsible for sending out those 1099s, but you can work with a professional tax preparer to send those out, or you can work with a professional payroll specialist to send out those W-2s. But just remember, you're the one that's responsible for them, not these firms that you're working with. And then January, February-ish, provide those records to the tax professional. So this should be the full previous year's records, the 1099s, you know, all that other stuff that was on kind of that general list. And then in March or April is when you're going to file your tax return and or if needed, file an extension, and then the tax return will be filed later in the year. So one thing that also can occur, but we didn't have it kind of in that list throughout the year, is quarterly estimates. So generally, self-employed individuals must pay quarterly estimates to the IRS. And if you're required to make an estimated tax payment, you can make one single payment by January 15th of the filing year. So for 2025, if you were required to make estimated tax payments for 2025, you could have made a single payment by January 15th of this year, you know, this month, and that would have taken care of your estimated tax payments. There are some special rules for qualified farmers, and we have qualified in quotes because there are a lot of different definitions of what is a farmer and what is farming throughout the tax code because it's used for different determinations and different purposes. For these purposes, there's specific criteria for what is a qualified farmer, and we have some information on that. Again, we're going to tell you how to get a hold of all of this information, but just recognize that there might be some differences there. Your tax preparer is going to be able to work with you on doing this. And then we talked about you. So in January, February-ish, you need to take that information to your tax professional. And so here's again just kind of a summation of what that information is that you need to take to your tax professional. So that summation of the current year transactions, the capital asset sales and purchases details, the 1099s you receive or 1099s that you sent out, end of year statements, other income producing accounts, forms, documents, anything for employee transactions, other end of year summary information that you might have. But as always, this really, to be really effective and a really good practice is just when you can find a tax professional that you guys can work cooperatively and work back and forth, you'll refine and get better at communicating with them. They'll get better at communicating with you. Some of this information, they'll have a starting point because you've worked with them in previous years, so they'll be able to use that information, you know what I mean, and then add to it with this current year's information. But always just so this was just kind of a broad overview of everything that to kind of think about taxes and give you some guidance there. So the resources, we kept alluding to that we have some more resources. So here's the resources. Uh, farmers.gov/taxes, that's where you're getting this webinar, the registration for it. This is where the recordings for this webinar will get posted. And I said we had the project with USDA. So the USDA website is farmers.gov/taxes, and then that can link back into materials on ruraltax.org. The same thing on ruraltax.org will link back into those recordings of the webinars and other information. There's a lot of different information there, but up on that website, there's something called tax topics. It's a menu item on the top of the page. So we click on that. At the very top of that page is going to be some boxes that have kind of collections of articles. And so there's various ones that you can explore. But then below that, there's going to be basically just an ongoing list of all the tax topics that we've written. And these are just short articles. They're meant to be digestible and accessible. You don't have to be a tax preparer to be able to use the information there. And then they're also something that you could actually take to and share with your tax preparer if you have, questions or other types of information. So some of the ones that we have on there that I think are appropriate for what things that we've gone over today are how to find a tax professional, Form 1099 information returns, government payments. With government payments, you are going to get a 1099-G, which is a specific 1099. Farming and who's a farmer for tax purposes, those definitions of farmers, filing dates and estimated tax payments. So that's where you're going to get those criterias for qualified farmer for estimated tax purposes and some of the other details around that. Working with a tax professional. And then also there's a tax estimator tool, which is Excel based, and you can put your information in there and well, I'll let Adam just kind of go over that tax estimator tool. He's the author of it anyway.
So the tax estimator tool is a pretty neat program. You need to fully understand it's not to do your taxes. This is really to take a look at potential different options when you're working, either doing it on your own or working with somebody else to start figuring out some tax estimates. So you have the ability to input your information. Where am I today? What do I expect to include for additional revenue between now and the end of the year, expenses, etc. That goes into one particular column. And then you go ahead and decide, well, what happens if I want to do some prepays because I can get a discount if I order the fertilizer now instead of, right before I need it. What would that look like from a change in tax liability, in SE tax, or anything along those lines? Or I'm going to purchase a capital asset and now I'm going to have some additional depreciation. That's really how this works. And I'm actually going to send the person that keeps Ruby and I on target an actual update, because we notice when you do something real specific, there's a weird little thing that kicks up. And so we've got that fixed and I need to update that. So that'll be done hopefully by the end of today. And we typically update that tax estimator tool every fall with the new updated limitations based on when the IRS is able to kind of get that out. But I also do not want to confuse people that may have filed extensions and still may be using it for the previous year. So usually August, September is when I'll unveil the most up-to-date one for the coming year.
And then we actually have an article that we're going to put the information from this webinar that we've gone over today into that article. It's drafted, but it's going to have to go through some review processes and other things. And so it'll be forthcoming and available sometime in spring of this year. And it'll be called Demystifying Tax Records. So again, these are available on ruraltax.org. If you just click on tax topics and then go through, it only lists so many, and then at the bottom it'll say more. And so a couple of these you'll have to go, there's quite a few articles, so you have to go through more a couple of times, but they're all there, and there's a lot of other good information there too. So just kind of go through those, but this is a list to get you started. And then thank you for attending. And if you have questions, follow-up questions, you can communicate with Janet Wright that hosted this webinar today and introduced it. And then there any of these are open questions, Adam, that we should go over?
So there have been a number of questions. I've responded to a few of them, but I think we ought to go over a couple because I know there's probably going to be other individuals that have similar questions. I do want to say that Robert Grosinger put up there some stuff about 1099s. It referenced a couple of IRS pubs, and he did make mention, and I know Ruby, you had stated it. There are a slew of different types of 1099s. We talked about, we do have a webinar that was done, and we have a document publication that talks about a number of the most common ones that farmers and ranchers are most likely to receive and or need to send out. But there are many, many different types, and different ones may have some slightly different rules to them. And so you really need to make sure you are brushed up on what those are so you know how to track some of those. So there was also a question on hunting leases on farm property. Are those required to be reported? Anytime you receive assets or even objects in place of cash, legally, you are required to report it. So let's say, I bought my family a new TV for Christmas. It's hanging on the wall. I don't typically watch TV, but the rest of the family really enjoys this giant screen. If a thief were to come in and rip that TV off the wall, legally, they are required to report the market value of that television and pay taxes on it as if they had received income for it. Okay? And so even if something is handed to me in cash instead of a check or through a credit card, you still must report that income. Then the next question is, where does it go onto a form? Is it farm income? Does it meet a de minimis rule? All these are considered facts and circumstances. Feel free to send us a question through Janet or through ruraltax.org. But most importantly, your tax professional you're working with will know all of and understand the facts and circumstances around your very specific question and your case. And so those are the best to be able to give you a better answer for you specifically, where Ruby and I are going to take a 10,000-foot view because there may be other things you have not told us about. And so when we respond to you, it's going to be really on that 10,000-foot view. Now, let's take a look at a couple of the open questions. Do we have a presentation on standing timber entities? There's a few of us on the committee that deal pretty heavily with timber. Why don't you try, you will find my contact information, and I will be more than happy to respond to some of those questions. I'll probably find out first, where are you from? And if I have a team member that understands and can deal with timber, we may point you in their direction. Timber the variables surrounding timber can get quite confusing and in depth very quickly. Okay. And so there's a lot of questions I'm going to ask of you that, to help determine who you are as a taxpayer, which is going to determine a lot of my responses. Okay. That's just that's the nature of timber. Okay. And so that, I think, let's talk about that. We do have some information within the publications that discuss timber. It's relatively done. It's done on a general basis. There are many on our committee that do have webinars or do live programs timber related. We do some specific for tax professionals. I think we will probably have one here later on in the spring through Clemson's tax school, and we've got other individuals affiliated again with our national committee that also work on some timber tax issues. Ruby, this one's going to be a good one. What about solar panels and crops that are integrated?
Going back to that definition of a farmer that we brought up earlier in the presentation, the reason we did that because that's really what farm activities and income associated with those activities is a farm. So the crops, the income and the expenses associated with the crops are a farm activity and need to be kept track of separately. So even if it might be integrated on your land, it's still because of the nature of the income that's coming in, the solar panel income is not a farming activity. But the crops are a farming activity, and so you're going to have to probably separate that out and keep track of that have the record keeping system be able to separate out the costs and returns associated with those two separately.
And this gets even more confusing because there's additional questions. Who owns the actual solar panels, right? Is that the landowner, the farmer themselves that are doing this? And we have a net metering contract with the utility company selling power back, or am I using some of this power? So we have all these questions that go in, or am I receiving a check from the owner of the solar panels, or am I renting the ground that has the solar panel? This gets very confusing very quickly. There is a lot of facts and circumstances that surround all of these different issues. It's not a cut and dry black and white issue.
So one that's more a little bit, having things combined, but going the other direction is what if the crops are used? What if you have crops that you're growing, you're using those as feed for your cow-calf operation? This is all still considered all farming activities. So we're still within the same business. We don't have to have a separate, separate out the cow from the crops. Now, for farm management purposes, we might want to do some separation, but for tax purposes, it's considered one business. And so the tax purposes, we're going to want to keep track of all of those costs that go into raising the fee, because that's probably where you're actually spending money, you know what I mean, or have a financial obligation. And then if the feed is being sold to somebody else, then we want to keep track of those because you have some revenue coming in. Maybe you sell some of the feed to somebody else. And then if the feed is being used for your cows as feed, then we need to also keep track of what the cow cells are going to actually show up on your tax return. The cost of producing the feed, the cost of raising the cows are going to show up on your tax return, but we don't have to actually separate those out because they're still all part of that farming operation.
Yeah, they're all farming activities. They would all fall under our Schedule F or appropriate form. The way to look at what is really taking place here is these are different enterprises on the farm, but they are all farm activities.
Yeah.
And so, as Ruby had said, if I am going to do a farm analysis, we may want to do some enterprising. But again, we get into how detailed do I want to handle it from an accounting perspective, where I may kind of do some quasi-enterprising with it so that I can do some analysis to figure out, is it worth me actually taking the crops that I am producing to feed to my cows and calves, or should I be buying it, right? That's managerial in nature, that's enterprising it and taking a look at it, which is different from the tax perspective itself.
Yeah, from the tax perspective, you don't have to separate anything else. From a management perspective, there might be reasons why you want to keep track of some of that separately.
And the last one here, this is pretty good. Somebody else may throw something up there before we get done with this, but I own 2 properties that are being used to produce lumber. Can they be called farms? One is also used to produce hay on an annual basis or yearly basis. So my question is, one, is it really being produced? What do we mean by lumber? Is it lumber or is it timber? Am I really producing 2x4s out of that wood? Do I have my own portable sawmill? Or am I hiring somebody in and contracting with somebody to come in, cut the timber off the stump, which is the terms that we typically use, and then they turn around and then they take it to the mill to be sold. And then I receive a check minus the cost to the folks that came in to cut it, right? And so if that's what's happening, can I be called a farm? So under IRS guidelines, when you begin to dive deep, the activity of raising timber itself is a farming activity. However, there is some contradictory code that goes, yeah, but what if, right? So are you a farm or are you a hobby? Do I have, am I making a profit 3 out of every 5 years? And all these other rules that begin to play a role in that really begins to complicate, am I
Yeah,
a
and
farm?
that's where those nuances come into play that we can kind of talk about some generalities, but it really kind of comes
Yep.
down to the personal situation. The hay, as long as you're selling it for a profit, then that hay is actually a farming activity. You need to keep track of those hay expenses and stuff for the farm. The timber, it depends, and you'll want to consult a tax professional with your situation.
There are, and I will tell you this, there is a program that's out there, I believe it's national, called Tree Farmers. And so it is a formal program that is usually run through cooperative extension or forestry commissions within the state that somebody can go through. You usually then get a nice sign you can put onto your property that says, I am a certified tree farmer. I'm not going to say that that holds weight by the IRS, but it does follow certain management and production techniques. And so that's something you may want to seek out as well. So,
So we're
uh,
kind of at the end, but there was one more question that came in, and so we'll handle this one, and then it'll be the end. But are family members, father and son, managing the farm together considered partners? This is it really depends because we don't know enough details and information about the situation. So if the farmer hires the son as an employee and they're managing the farm together, the father has a farm and he has an employee, the son is an employee, they're not in a partnership. Um, you could also have a situation where there's one account for the farm, the son can sign on that account, the father can sign on that account. Um, they go through and they file the proceeds and the costs and stuff associated with that farm as a partnership return. And then each individual, the father and the son, their proportion of the profits from that partnership farming operation would get passed through to their own individual tax returns, and that's where the taxes would be paid. And so it really kind of it depends on what, again, that's why we say on these questions and stuff, we can look at the 30-foot view, 1,000 view, but it really kind of a lot of times there's not enough details and information to really kind of go over in general. So I think that wraps us up today. Thank you for joining us. As Janet's already said, I think a couple of times in the chat and stuff, the recording for this webinar will be out in a few weeks, and then Janet will send that out and post it to the website when we get that. And be sure to check out some of these other materials that we've identified for you. And thank you for joining us.
thank you.